The acquisition and expenditure cycle is a significant component of financial transactions within an organization and encompasses everything from the initiation of a purchase to the actual payment. In today's lecture, we will explore the key processes involved, the inherent risks, and the essential audit procedures to ensure accuracy and reliability of financial statements. Understanding the flow of transactions within the acquisition and expenditure cycle is crucial for auditors. Transactions typically originate with a need identified within the organization, progress through the purchasing and receiving stages, and conclude with the payment for goods or services. This flow provides a roadmap for auditors to trace and validate the completeness and accuracy of recorded transactions. The primary stages in the acquisition and expenditure cycle include the purchasing process. This initial phase involves the identification of a need within the organization, the creation of purchase requisitions, and the subsequent issuance of purchase orders. It is critical for auditors to scrutinize the authorization and documentation of these transactions to ensure compliance with established policies. Once goods or services are delivered, the receiving process comes into play. Auditors need to assess the effectiveness of controls in place to ensure that only authorized goods are received and proper documentation, such as receiving reports, is generated. When goods or services are received, the organization recognizes an increase in its liabilities because it now owes payment for those goods or services. This creates an accounts payable or similar liability. Simultaneously, the organization recognizes an expense related to the goods or services received. This reflects the consumption of resources and aligns with the matching principle. The final stage in the process is the payment process. The payment process involves the verification of invoices, approval for payment, and the actual disbursement of funds. Auditors must thoroughly examine the supporting documentation to verify the legitimacy of transactions and adherence to payment terms. Understanding the stages of the acquisition and expenditure cycle lays the foundation for effective risk assessment and the development of appropriate audit procedures to ensure the reliability of financial information. One of the primary objectives of auditing the acquisition and expenditure cycle is to verify that all transactions within this cycle are appropriately authorized. This involves scrutinizing the documentation associated with each stage, from purchase requisitions and orders to receiving reports and invoice approvals. Auditors aim to ensure that only authorized individuals have the power to initiate, approve, and execute transactions, mitigating the risk of fraudulent or unauthorized activities. The accuracy of recorded transactions is also fundamental to the reliability of financial statements. Auditors employ substantive procedures such as detailed testing and analytical reviews to verify that the amounts recorded in the financial records align with the actual transactions that took place. This includes confirming that the quantities, prices, and terms of acquisitions are accurately reflected in the accounting records. Auditors are also responsible for confirming that transactions are not only accurate, but also appropriately classified and reported in the financial statements. This involves assessing whether transactions are recorded in the correct accounts and financial statement categories. Misclassification errors can distort the financial picture of an organization and mislead stakeholders, making the correct classification a crucial aspect of the audit process. The acquisition and expenditure cycle is heavily reliant on internal controls to safeguard against errors, fraud, and mismanagement. Auditors evaluate the effectiveness of these internal controls to gain assurances about the reliability of the financial reporting process. This assessment includes reviewing the design and implementation of controls, as well as testing their operating effectiveness. Any weaknesses or deficiencies identified in internal controls are communicated to management as a part of the audit findings. By achieving these objectives, auditors contribute to the overall reliability and transparency of financial reporting. The audit process not only serves as a check on the accuracy of financial information, but also provides valuable insights into the effectiveness of an organization's internal controls. Unrecorded liabilities represent a significant inherent risk in the acquisition and expenditure cycle. This risk arises when an organization fails to recognize certain obligations or liabilities in financial statements. These unrecorded liabilities can lead to an understatement of expenses, affecting the accuracy of financial reporting. Examples include outstanding invoices. An organization receives goods or services but fails to record the corresponding invoice. This may occur due to oversight, delays in processing invoices, or inadequate controls. As a result, the financial statements may not accurately reflect the true extent of the organization's outstanding obligations. Accrued expenses also create another risk of unrecorded liabilities. Some expenses may be incurred but not yet invoiced. For example, a company might have incurred utility expenses for the current month, but the invoice is not received until after the financial reporting period. Failure to accrue for these expenses can lead to an understatement of liabilities. Contingent liabilities represent legal claims or warranties that have not been recognized in the financial statements. Failure to identify and record contingent liabilities can lead to a lack of transparency in the financial statements, potentially exposing the organization to unforeseen financial risks. A non-cancelable purchase agreement is a contractual arrangement between a buyer and a seller wherein the buyer commits to purchasing a specified quantity of goods or services, and the seller commits to delivering those goods or services at predetermined terms and conditions. The key characteristics of a non-cancelable agreement is that the buyer is obligated to fulfill the terms of the contract and cannot easily cancel or terminate the agreement without incurring significant penalties or costs. Inherent risk is increased by these types of agreements because determining the fair value of non-cancelable purchase agreements for financial reporting purposes can be challenging. Estimating the impact of potential penalties or costs associated with cancellation requires careful consideration and may involve subjective judgments, introducing complexity and uncertainty into financial statements. Auditors need to carefully assess the terms and implications of such agreements during the audit process to understand and address the associated risks appropriately. Capitalizing expenses involves treating certain costs as assets rather than recognizing them as expenses immediately. This poses an inherent risk as it can lead to an overstatement of assets and an understatement of expenses, thereby affecting the organization's reported profitability and financial position. For example, capitalizing costs that should be expensed, such as research and development costs that do not meet the criteria for capitalization. This can artificially inflate the value of assets on the balance sheet and distort the organization's financial position. Capitalizing interest costs that do not qualify for capitalization under accounting standards is another example. This can occur when financing costs related to construction projects are inappropriately included as a part of the asset's cost. It can result in an overstatement of the asset's value and impact reported profitability. Overall, addressing inherent risk requires careful scrutiny during the audit process. Auditors need to assess management's judgments and estimates regarding liabilities, closely examine the organization's policies for recognizing expenses, and ensure adherence to accounting standards to provide reasonable assurance that the financial statements accurately reflect the entity's financial position and performance. Auditors use a variety of data files and management reports to gather audit evidence related to the acquisition and expenditure cycle. These sources provide information on transactions, internal controls, and the overall financial performance of the organization. Some common data files and management reports include the accounts payable subsidiary ledger. This ledger provides detailed information on individual accounts payable transactions. It includes data such as vendor names, invoice dates, amounts, and payment terms. Auditors use the accounts payable subsidiary ledger to verify the completeness and accuracy of recorded payables. They may select a sample of transactions for detailed testing to ensure proper authorization, accuracy, and adherence to payment terms. The open purchase order file contains information about purchase orders that have been issued but have not yet been fulfilled or completed. It typically includes details such as the purchase order number, vendor information, item descriptions, quantities ordered, and the agreed upon prices. Auditors use the open purchase order file to verify the completeness of recorded transactions in the cycle. By comparing the open purchase order file with recorded transactions, auditors can identify any purchase orders that have not been properly accounted for in the financial records. Auditors examine the open purchase order file to ensure that purchase orders are properly authorized before being issued. They also check for supporting documentation such as approvals and justifications to confirm that the purchases are in accordance with the organization's policies. The open purchase order file provides auditors with insights into the organization's commitments for future expenditures. This information is crucial for assessing the potential impact on financial statements and understanding the financial obligations the organization has entered into. Another source of evidence are unmatched receiving reports. The file of unmatched receiving reports contains records of goods or services that have been received but may not have been properly matched with corresponding purchase orders and vendor invoices. It includes information about the items received, quantities, and the date of receipt. Auditors use the file of unmatched receiving reports to perform completeness testing. They compare the information in this file with recorded transactions to ensure that all received goods or services are accurately reflected in the financial statements. Unmatched receiving reports may indicate weaknesses in internal controls related to the three-way match process. In other words, matching purchase orders, receiving reports, and vendor invoices. Auditors assess the effectiveness of these controls and may perform additional tests to ensure that all three components are appropriately matched. Discrepancies between receiving reports and other documents may indicate errors, fraud, or unauthorized activities. Auditors investigate any unmatched items to determine the reasons for discrepancies and to identify and address potential risks to the reliability of financial information. Unmatched receiving reports may highlight delays in recording transactions in the financial system. Auditors assess whether there are significant timing differences between the receipt of goods or services and their subsequent recording, ensuring that financial information is reported in the appropriate accounting period. The unmatched vendor invoice file consists of records of vendor invoices that have been received but may not have been properly matched with corresponding purchase orders and receiving reports. These unmatched invoices represent a situation where there is a discrepancy or failure in the three-way match process. Auditors use the unmatched vendor invoices file to perform completeness testing. They compare information in this file with recorded transactions to ensure that all vendor invoices are accurately reflected in the financial statements. Any invoice missing from the accounting records may indicate a potential understatement of liabilities. Unmatched vendor invoices may also signal weaknesses in internal controls related to the three-way match process. Auditors assess the effectiveness of these controls to ensure that vendor invoices are properly reviewed, approved, and matched with corresponding purchase orders and receiving reports before payment. Discrepancies between vendor invoices and other documents may indicate errors, fraud, or unauthorized activities. Auditors investigate any unmatched items to determine the reasons for discrepancies and to identify and address potential risks to the reliability of the financial information. Unmatched vendor invoices may highlight delays in recording transactions in the financial systems. Auditors assess whether there are significant timing differences between the receipt of vendor invoices and their subsequent matching with purchase orders and receiving reports. Timely and accurate recording is crucial for financial reporting integrity. Auditors use the unmatched vendor invoice file to verify the completeness of liabilities recorded in the financial statements. Failure to match vendor invoices with corresponding purchase orders and receiving reports may result in the omission of liabilities, impacting the accuracy of the financial statements. Overall, incorporating information from various data files and management reports allows auditors to obtain a comprehensive understanding of the acquisitions and expenditure cycle, assess risk, and gather sufficient audit evidence to support their conclusions. Auditors often employ a combination of substantive procedures, analytical reviews, and testing of controls to ensure the reliability of the financial information related to this cycle. Key management assertions related to accounts payable include the existence assertion. Accounts payable balances exist and represent obligations of the entity at a given time. Completeness, all liabilities for goods and services received or obligations incurred are included in the accounts payable balance. Rights and obligation, the entity has legal title or the right to pay the recorded liabilities. Valuation and allocation, accounts payable are recorded at the correct amounts and are appropriately allocated. With respect to the assertions related to expenses, occurrence, expenses recognized in the financial statements represent costs that were actually incurred by the entity during the reporting period. Completeness, all expenses that should have been recognized during the reporting period are included in the financial statements. Accuracy, amounts recorded for expenses are accurate and have been calculated correctly. Cutoff, expenses are recorded in the correct accounting period. And classification, expenses are classified in the appropriate accounts and financial statement categories. Understanding and testing these management assertions are essential for auditors to provide reasonable assurance regarding the reliability of financial statements, specifically related to accounts payable and expenses. Through a combination of substantive procedures, tested controls, and analytical procedures, auditors can assess the validity of these assertions and the overall integrity of financial reporting. Key control activities related to accounts payable are essential for addressing management assertions about completeness, existence, cutoff, and valuation. These control activities help ensure the accuracy and reliability of financial reporting in the accounts payable process. Effective controls helps ensure that expenses are accurately recorded, complete, and properly classified in the financial statements. Incomplete recording of expenses may lead to understated expenses in the financial statements, potentially misrepresenting the financial performance of the organization. Examples of internal controls include expense reconciliation. Regular reconciliation of general ledger accounts to supporting documentation helps identify and correct any missing or omitted expenses. Procedures for reviewing unusual transactions can help detect any anomalies or patterns that may indicate missing expenses. Incorrect timing of expense recognition, where expenses are recorded in the wrong accounting period, can distort financial results and mislead stakeholders. Internal control examples include accrual procedures implemented to recognize expenses in the correct accounting period, even if invoices are received or paid in a different period. With respect to accuracy, errors in the recording of expenses, whether intentional or unintentional, can lead to inaccuracies in the financial statements. Therefore, internal controls such as authorization of expenditures are important. Controls for authorizing expenditures, such as requiring purchase orders and approvals, help ensure that only legitimate expenses are recorded. Also, controls related to expense coding are necessary. Controls to ensure accurate coding of expenses to the correct accounts and cost centers contribute to the accuracy of financial reporting. Finally, misclassification of expenses can lead to distortions in the presentation of financial information, affecting the interpretation of financial statements by stakeholders. To address this risk, controls should include a well-structured chart of accounts with clear guidelines on account classification, which helps ensure that expenses are appropriately categorized. In summary, internal controls related to expenses should help safeguard the integrity of financial information, providing assurance to stakeholders that the financial statements accurately reflect the organization's financial performance. Auditors assess the design and effectiveness of these controls during financial audits to ensure the reliability of expenses reported in the financial statements. Key risks associated with purchases include the risk that purchases received have not been properly recorded. Incomplete recording of purchases may result in understated expenses, leading to inaccurate financial statements. Control activities to mitigate the risk include purchase order approval. An entity should require that a purchase order be generated and approved before any goods or services are procured. Three-way matching is another important control activity. The entity should ensure that a three-way match is performed for all purchases. This three-way match involves matching purchase orders, receiving reports, and vendor invoices. There's also the risk that purchase amounts and other data related to significant purchase transactions and events have not been recorded properly. Errors in recording purchase transactions can lead to misstated financial information. Examples of control activity to mitigate the risk includes authorization controls, which are implemented to ensure that purchase transactions are authorized by appropriate individuals. Another example is documentation review, which includes regular reviews of supporting documentation to verify the accuracy of recorded purchases. Purchases being recorded in the incorrect period is another risk. Incorrect timing of purchase recognition may lead to financial statement misstatements. Example of control activities to address the risk. An entity could establish procedures for reviewing and closing purchase transactions at the end of each accounting period. For example, they can conduct a detailed review of open purchase orders and outstanding invoices to ensure proper cutoff. They could also implement a process for reviewing and approving any late or out of period entries. And finally, there's the risk of misclassification of purchases, which can result in inaccurate financial reporting. Internal control activities to mitigate the risk include implementing controls to ensure that purchases are coded to the correct accounts and cost centers. Entities should establish clear guidelines for coding purchases to specific expense accounts and regularly reviewing compliance with these guidelines. Overall, internal controls should be designed to collectively address the risk associated with purchases of goods or services to provide assurance that financial reporting is accurate, complete, and in compliance with accounting standards. Regular monitoring, documentation reviews, and adherence to established procedures contribute to the effectiveness of these controls in mitigating risks related to purchases. Auditors typically assess the design and implementation of these controls during the audit to ensure the reliability of purchase transactions in the financial statement. Within the acquisition and expenditure cycle, the nature of audit evidence can vary depending on the specific accounts and assertions. For example, with respect to accounts payable and accrued liabilities, audit evidence would include examining vendor invoices, purchase orders, receiving reports, and other supporting documentation to ensure that all liabilities are recorded. For property, plant, and equipment, audit evidence would include physical inspection and observation of assets to ensure they exist and are complete, examination of deeds, titles, and contracts to confirm ownership and legal obligations related to the asset. With respect to capitalized expenditures, a review of capital expenditure requests, approvals, and supporting documentation to ensure all relevant transactions are recorded accurately. By employing a combination of audit procedures, auditors can gather sufficient and appropriate evidence to support their conclusions on the financial statement assertions related to acquisitions and expenditures. The nature and extent of audit evidence, again, depends on the assessed risk, materiality, and specific characteristics of the client's operations. The completeness assertion is a significant risk in the acquisition and expenditure cycle, and it pertains to the concern that all transactions and accounts that should be recorded in the financial statements are in fact included. The completeness assertion is crucial because the omission of transactions or accounts can lead to an understatement of liabilities and expenses, resulting in a material misstatement in the financial statements. To address the completeness assertion, auditors may perform various audit procedures. For example, auditors may choose a sample of accounts payable transactions and trace them back to purchase orders, receiving reports, and vendor invoices. They may also confirm accounts payable balances directly with vendors to ensure that all outstanding liabilities are accounted for. They can also perform analytical procedures such as analyzing the ratio of expenses to revenue over multiple periods and comparing it to industry benchmarks to identify potential omissions. They should also interview the accounts payable department manager about procedures in place for capturing all vendor invoices and payments. Auditors may also scan through a sample of purchase transactions to identify any missing or unrecorded invoices. Addressing the completeness assertion is crucial in mitigating the risk of material misstatement in financial statements. A combination of substantive audit procedures, internal controls, and thorough documentation reviews enhances the ability to provide reasonable assurance regarding the completeness of transactions and accounts in this cycle. Auditing accrued liabilities and expenses involves certain risks and difficulties due to the estimation and judgment involved in determining these amounts. Accrued liabilities represent obligations that are recognized before the associated cash payment is made, and accrued expenses are costs that have been incurred but not yet paid. The risk and difficulties in auditing accrued liabilities and expenses primarily stem from the subjective nature of estimates and the potential for management bias. For example, there may be a risk of management intentionally manipulating accruals to meet financial targets or present a more favorable financial position. Accruals are also sensitive to the timing of transactions, and cutoff issues may arise in determining the appropriate period for recognition. Properly assessing the cutoff requires a detailed review of transaction documentation and confirmation with external parties. By implementing a combination of substantive audit procedures, auditors can address the risk and difficulties associated with auditing accrued liabilities and expenses. For example, auditors should examine supporting documentation for accruals, including invoices, contracts, and other relevant agreements. They should also identify significant fluctuations that may indicate errors or bias in management estimates. Auditors should also evaluate the process used by management to estimate accruals, considering the methods, assumptions, and data sources. They should assess the reasonableness of management's estimation process and identify any potential biases. Auditors also engage legal letters from the firm's legal counsel to review and confirm the validity of accrued legal liabilities. This provides external validation of the existence and completeness of legal accruals. Overall, the objective is to gather sufficient and appropriate audit evidence to support the reasonableness of management's estimates and ensure the accurate representation of these financial statement components. Fraud red flags are indicators that may suggest potential fraudulent activities. These red flags are important for auditors to recognize as they can signal various forms of fraudulent behavior, including overbilling, fictitious invoices, or collusion between employees and vendors. For example, consistent use of sequential invoice numbers, which may indicate the creation of fictitious invoices. Invoices submitted outside normal billing cycles or during periods of low oversight. Vendors with no physical address or presence indicating potential fictitious entries. Limited or non-existent business history for vendors submitting significant invoices. Auditors should remain vigilant for these red flags during the examination of the acquisitions and expenditure cycle, particularly in the review of vendor invoices.